Open your fridge. Check your phone. Look at the logo on your running shoes. Your next great stock idea is already in your life. Peter Lynch built an empire at Magellan, not by chasing whispers, but by noticing what millions of people were already buying and understanding why. He took the Magellan Fund from a small, overlooked pool of capital to one of the world's most watched portfolios, year after year, compounding at a pace that made the street blink. His edge wasn't secret data or a crystal ball. It was curiosity with a clipboard. It was walking the mall, calling store managers, reading the footnotes, trusting the evidence of real customers in the real world. Invest in what you know. Doesn't mean buy your favorite brand because you like the taste. It means start where you have an information advantage: your job, your neighborhood, your shopping cart, and then do the work. If the lines are longer, are profits growing? If the product is everywhere, is the balance sheet solid? If the buzz is loud, are returns on capital actually improving? Lynch hunted 10-bagger stocks that could rise tenfold. They rarely begin as headlines. They start as useful, loved, quietly spreading products and services. A new retail format that keeps opening profitable stores. A niche software tool every small business adopts. A low-cost manufacturer that keeps shaving costs and widening margins. He didn't buy the market. He bought stories with numbers behind them. He held long enough for the numbers to become obvious. He sorted companies into 6 simple tribes to set expectations before he bought. Fast growers, small companies expanding 20 to 50% a year. Huge potential, high volatility: watch unit economics and store-by-store results. Stalwarts, big, steady brands growing 10 to 12%. Less upside, but dependable by them when they're dull and cheap. Slow growers. Mature companies with modest growth, only interesting if they return mountains of cash. Cyclicals, earnings rise and fall with the economy. Don't buy them when times are great. Buy when things look awful but survivable. Turnarounds, broken stories with fixable problems. Tight leashes, clear catalysts. Asset plays, hidden value on the balance sheet: real estate, resources, or cash piles the market ignores. Category first, thesis second. Because the way you'll be right or wrong depends on what kind of company it is. Lynch's 2-minute drill was ruthless. If you can't explain to a friend, in plain English, why this business wins, and what will prove you right in the next 12 to 24 months, you don't know it well enough to own it. No jargon, no vibes. This chain opens new stores at high returns. Payback under 2 years. Debt low, same-store sales rising. Lots of cities left. That's a thesis. Feels like the future isn't. He matched every story with numbers that mattered. Growth, organic revenue, same-store sales, users, pricing power, durability, gross and operating margins, return on invested capital, customer retention, discipline, inventory turns, receivables, debt maturity, share count, runway, new markets, new formats, adjacent products that don't break the core. And he watched management for the one trait spreadsheets can't grade. Honesty, owners who tell you the bad news first and spend like the money is theirs. Leaders who buy back stock when it's cheap and invest when returns are real, not theatrical. Lynch ran a giant fund, but his lesson to individuals was simple. You don't need 50 perfect picks. A handful of big winners can carry an entire portfolio. You can only lose 100% in a stock, but you can gain far more than that if you catch excellence early and hold on when it's merely boring. So here's your field guide today. Scout your life. List 5 products or services you use more this year than last. Ask 3 people outside your bubble what they're using and why. Do the 2-minute drill. What does the company do better than rivals? How does it make money? What could break the story? What proof will show up in the next few quarters? Tag the tribe. Fast grower, stalwart, cyclical, turnaround, slow grower, or asset play. Pick one, and set expectations accordingly. Check the numbers: revenue quality, margins, cash flow, debt, share count. If the math doesn't rhyme with the story, pass. Start small, learn fast. Open a tracking position only if the thesis and the numbers agree. Add on execution, on thesis breaks, not on headlines. Magellan's magic wasn't magic. It was pattern recognition, practice daily. It was noticing the new coffee chain that stays packed without discounts, the chip supplier embedded in 3 rising devices, the hospital software that every administrator calls the only one that actually works. It was connecting parking lot traffic to income statements. You already live in a stream of scuttlebutt. Turn it into an edge. Tonight, pick one company that's already in your routine. Write the 2-minute reason it wins. Circle the metric that will prove you right or wrong. If it's clean by a slice you can sleep with, and give it time to grow from obvious to you to obvious to everyone. If this gave you a better lens, use it. Invest in what you know and what you can explain. Then subscribe for the next deep dive. We'll keep turning everyday evidence into high-conviction decisions. One storefront, one footnote, one 10-bagger at a time.